Picture two people. One flips burgers for $40,000 a year. The other owns the building that restaurant sits in, and last year his net worth quietly went up by $4 million. At tax time, the burger flipper watches a painful slice of every paycheck vanish before it even lands. Income tax, Social Security, healthcare. And the more you earn from a job, the bigger that slice gets, all the way up to 37%. The building owner? He might pay almost nothing. Some years, literally nothing. Same country, same tax code, same rules. And here's the part nobody explains. The rich guy isn't breaking the law. He's not stuffing cash in a suitcase. He's not flying it to some secret island. He's just reading a different page of the same rulebook you were handed in school, a page they never bothered to show you. Today, you're going to read it too. So let's start with the one idea this whole thing is built on. Because once you see it, you can't unsee it. The tax system doesn't punish wealth. It punishes a paycheck. We'll get to it. But it only lands once you understand the trap you were born into. Income. Here's the trap almost everyone is born into. You trade your hours for money. That money is called income, and income is the single most heavily taxed thing in the entire system. The government takes its cut the instant you earn it. It's gone before it hits your account. You never even hold it. By the time you see your balance, the tax has already happened to you. And there's no real way around it. You can't hide a paycheck. Your employer reports it. The IRS already has a copy. They know exactly what you owe. They just make you fill out the form anyway, like the world's most passive-aggressive pop quiz. The game is rigged so the working person plays on hard mode every single payday. It's like getting mugged by someone polite enough to mail you a receipt afterward. So if income is the most taxed money there is, the obvious question becomes, what if you simply didn't earn income? That sounds insane. Everyone needs money to live. But this is exactly the move the wealthy make. And it's completely legal. Assets. The rich don't get rich from a salary. They get rich from owning things that grow, stocks, companies, real estate, pieces of businesses that quietly climb in value while they sleep. And here's the magic word that runs this entire system: unrealized. When a stock you own goes up, you haven't actually made any money yet, not in the eyes of the law. That gain only becomes real or realized the moment you sell. And until you sell, it isn't income. And if it isn't income, it can't be taxed. Let that sink in. A man can own $10 billion in stock. That stock can grow by $1 billion in a year. And his tax bill on that billion can be exactly zero. Because he didn't sell. He just held. On paper, he's $1 billion richer. On his tax return, he had a nice quiet year. This isn't a theory. In 1 year, the 25 richest people in America reported a combined $158 million in wages. Sounds like a lot. It was barely 1% of what they actually made. The other 99% grew silently inside assets the tax man never touched. Warren Buffett, one of the richest humans alive, paid himself a salary smaller than some middle managers. Why hand yourself a paycheck the government can carve up, when you can let your fortune grow untaxed instead? So that's how the rich avoid income. They don't earn it. They grow it. But eventually they need actual cash, right? You can't buy a yacht with stock you refuse to sell. So how do they spend without selling? Because the second they sell, the tax finally shows up. Well, sort of. Because even selling is rigged in their favor. The patience discount. When you finally do sell an asset you've held for more than a year, you don't pay normal income tax rates. You pay something called long-term capital gains tax, and those rates are dramatically lower. Wages can be taxed up to 37%. Long-term gains, 0, 15, or 20% for almost everyone. That's it. Think about how strange that is. The money you break your back for gets taxed up to 37%. The money your money makes while you do nothing gets taxed at 15%. The system literally rewards owning over working. The laziest dollar in your account is the most tax-efficient one you own. Show up to a job, punished. Sit on a couch and own things, rewarded. The priorities kind of write themselves. But even 15% is more than zero. And the truly wealthy have figured out how to pay closer to zero. To do that, they use a strategy with a name so blunt it sounds made up. It's called buy, borrow, die. 3 words. They are, quietly, the most powerful wealth formula in modern finance. Let's take them one at a time. Buy. Step 1. Own appreciating assets and never sell them. We just covered why. The moment you sell, you trigger tax, so the rich treat their assets like a fire they refuse to put out. They let it burn brighter and brighter and never cash it in. But that creates the problem from before. If you never sell, how do you get spending money? Borrow. This is the move that breaks people's brains the first time they hear it. The wealthy don't sell their stock to fund their lives. They borrow against it. A bank looks at a billionaire holding billions in shares and says, "You're good for it." So they hand over a loan using the stock as collateral. And here's the trick that makes the whole thing work. A loan is not income. You didn't earn it. You have to pay it back, so legally it isn't taxable. The billionaire now has millions in cash to spend on houses, jets, and lifestyle. He paid zero tax to get it. And his stock is still sitting there, untouched, still growing. He's living off borrowed money, secured by an asset he never sold, taxed at a rate of nothing. But the loan has interest, you might say. True. But the interest on that loan is far less than the tax he'd owe by selling. He's paying a little interest to dodge a bill that could swallow 37% of the sale. That's not a cost. That's a discount. So now he's spending freely and paying almost nothing. But surely there's a final reckoning. Eventually he dies, and surely all that untaxed gain gets settled then. That's where the third word comes in, and it's the most ruthless one. Die. When a normal person inherits assets, you'd expect them to owe tax on all that growth that was never taxed while the owner was alive. Decades of gains, a massive bill finally coming due. Nope. There's a rule called the step-up in basis. The moment the owner dies, the asset's value resets to whatever it's worth that day. All the gains that built up over an entire lifetime, every dollar that was never taxed, are simply erased. Picture this. A man buys stock for $20,000. Over his life, it grows to $200,000. That's $180,000 in gains that was never taxed because he never sold. He dies. His daughter inherits it. She sells it the very next day for $200,000. Her tax bill? Zero. The $180,000 in growth didn't get taxed at death. It got forgiven permanently. The slate is wiped clean and the fortune passes down, fresh and untaxed, ready to do the whole cycle again. Buy, so you never trigger tax. Borrow, so you can spend without selling. Die, so the tax disappears forever. The loans get paid off from the estate, and the gains that funded an entire luxury life are never taxed at all. You might be thinking, okay, but there's an estate tax, right? There is. But it only kicks in above about $15 million per person. For the merely wealthy, the whole thing slides through clean. For the truly rich, an army of lawyers and trusts shrinks it down to a fraction. Now, you don't have to take any of this on faith. In 2021, a leak of real IRS records pulled the curtain back. It found that the 25 richest Americans saw their fortunes grow by $401 billion over 5 years. On all of that, they paid $13.6 billion in federal income tax. Run the math, and that's a true tax rate of 3.4%. 3.4. Jeff Bezos, in 2 separate years, paid $0 in federal income tax. Elon Musk did it too, in 2018. The richest man on earth. Nothing. And these weren't crimes. Every one of them. Perfectly legal. Now hold that next to a regular worker. Over those same years, a typical wage earner in their 40s saw their wealth grow by about $65,000 and paid roughly $62,000 in taxes, almost as much as they gained. The billionaire grew $400 billion and paid 3%. The worker grew $65,000 and paid nearly all of it. And buy, borrow, die is only the headline act. There's a whole supporting cast. Real estate owners use something called depreciation, a paper loss on a building that's actually rising in value, used to wipe out real income on their tax form. Fund managers use a loophole called carried interest to have their pay taxed as low-rate gains instead of high-rate income. The richest set up private foundations, giving away money in ways that lower their bill while keeping influence over where it goes. Different tools, same blueprint every time. Turn income into assets, turn selling into borrowing, turn high rates into low ones. So here's what I want you to actually walk away with. Every rule we just covered is published, public, and sitting in the open for anyone to read. The wealthy didn't find a cheat code. They just read the manual that the rest of us were never handed. That's the real divide. It was never the rich versus the poor. It was the people who understand the rules versus the people who were never taught them. And the rules don't actually care who you are. They reward owning over earning, patience over selling, assets over paychecks. That's it. That's the whole game. You can resent it, or you can learn to play it. Slowly, in your own small way, the same direction the rich are already pointed. So think back to those 2 people from the start, the one flipping burgers and the one who owns the building. The difference between them was never luck. It wasn't even money, not really. It was a single page of a rule book. And you just read it.